I think the biggest difference between the two countries is just probably the depreciation methods. And over a 10 or 15 or 20-year period, if someone's renting out that property, I would expect that the cost basis for U.S. purposes would be very different. It could be much lower
Right.
than the cost basis for paying tax purposes because, general terms, if you rent out property, especially if it's a vacation property, you're probably breaking even at best. So you're not depreciating it from a Canadian tax perspective,
Right.
but you are from a U.S. perspective. And those losses will be deductible on sale. Those are some of the biggest nuances and differences between that.
Okay. So the depreciation is forced down in the States. If you are only reporting that rental income, or in this particular case, a loss, that would just accumulate over time. And then when you eventually sold it, then those losses would kind of apply when you recognize that final gain. Is that correct?
That's correct. So you'd be accumulating something called past activity losses or just, rental losses, whatever the nature of the property is. And, when you sell the asset that triggered those losses, then they would be deductible or claimable against the gain.